Hi, how you doing, guys? My name is Frank Kriticos, and the topic we're going to cover today is having a good, healthy credit profile. Oftentimes when I'm speaking with clients, I mention a healthy, balanced diet, right? So fruits, greens, vegetables, so on and so forth. It's the same exact thing when it comes to having a healthy, balanced credit report. Now, this is very, very important because you could be really good over here and not so good over here, and that's not going to equate to a good credit score. Now, with that being said, I often try to steer my clients and really everybody away from online when it comes to getting credit information. The reason being is because I just believe there's a lot of wrong information out there, and also there's a lot of old information. So the way that I have learned about the FICO scoring model is literally by studying, I don't know, 5 to 10,000 credit reports. I have no idea what that number is, but this is my full-time company, and all I do all day is study credit reports for the past 11 years. Okay, so again, what we're going to cover is one of the very few things that I actually tell my clients that it's okay to agree with when it comes to watching this or learning about this online. Okay, so again, overall good credit profile. So let's cover it right now. So 35% of our score is our payment history. Okay, so what does that exactly mean? Let me write it down first. 35% equals payment history. So this sounds pretty obvious, right? But what exactly does it mean? Does it mean paying your bills on time? Yes, but this is, let's look at it a little bit more in depth. If your credit card bill is due on the 1st of the month and you pay it on the 5th, that's okay. If you pay it on the 20th and you get hit with a late fee, that's still okay in our world of credit scoring. Now, it's not good financially because you're paying more money, and we don't want to do that. But in the world of credit scoring, it's still okay. What we're really talking about is a full 30-day cycle. A 30-day late payment is very, very, very damaging. Let me give you an example. If I have a client that has a 750 score, which is a great score, and they miss a minimum payment on their credit card for 10 bucks, and they incur a 30-day late payment, up to 100 points right off the bat. That's how important it is to have good payment history. Alrighty, so 35% of our score, pay your bills on time. Just make sure you're not a full 30 days late. Pretty self-explanatory, but I just wanted to highlight how important it is to pay your bills on time. The next one, which is 30% of our score, is the DUR, which is the debt utilization ratio. So what does that mean in English? It means basically maxing out your credit cards. Okay, so this is something that's very, very important as well. Whenever we max out our credit cards, very, very hurtful. As you can see, it's 30% of our score, very damaging. Now this is where you have to be really, really careful. You have to be careful with these low limit credit cards, $300 limits, $500 limits. It's very, very easy to max them out. Even if you have especially if you have a family and you go to the grocery store a couple of times, you're probably maxed out. Very damaging. What's very important to know is that it's not about the dollar amount. Okay, it's all about the ratio. It's all about the percentage. So let's use easy math here. $1,000 credit card limit and your balance is $1,000. That's 100% utilized. Very damaging. The magic number, and I get to ask this question all the time, there's really two numbers. The highest that you should be is at 30%. So $1,000 limit, keep your balance at $300 or less. That's okay. Ideally, you want to be at 10% or less. Okay, so $1,000 limit, $100 balance or less, and you're golden. Now remember, it's all a ratio, it's all a percentage. So if you have a $100,000 credit card, which I don't even know if they offer anymore, I don't think they do, and you have a $30,000 balance, it's still 30%. So it's all the ratio and has nothing to do with the actual dollar amount. Okay, very, very, very important. The next one's going to be 15%, and that's the length of credit history. So basically what this really means is our length of history. So this is why a teenager will rarely have good credit, because they only have a very short time for any credit history. So in our world, it's called lack of credit, which is not good either. So lack of credit, bad credit, it's the same thing because it's still a bad score, okay? You never want to cancel credit cards because when you do, you are shortening your credit history. I personally only have 3 credit cards. One of the banks I won't disclose, I don't like them so much, but I've had them for, I don't know, 15 years. So if I close that card, I'm going to lose 15 years of my history and my score will probably go down because I only have 3 accounts. Now, if you have 15 credit cards and you've had them all for 10, 15 years, you could still close them and you'll be okay, but you really just have to be careful when you only have a few. It's just like anything else. The more cards you have, the less weight it actually has in terms of if you close them, how many points your score will go down because of the credit history. So for me, I only have 3 credit cards. So if I close one, I'm down to 2, and that makes a big difference. But again, so I don't want everybody to go out there and just start, you know, closing credit cards because that's not good. On the other hand, if you have a lot of cards and you want to go from 15 to 10, you're still okay. Okay, so that's all that means. It's 15% of our score. Not a big deal, but it's still something to think about. Okay, so the next one's 10%, and that's the mix of accounts. So again, we're talking about 10%, not a big deal, but what this basically means is that, again, a profile, a healthy balanced diet. Ideally, they want to see 3 to 5 revolving accounts, which is 3 to 5 credit cards, okay? An auto loan, which is an installment loan. A mortgage is an installment loan. Student loans are installment loans, okay? So to have a good mix, a couple credit cards, an auto payment, maybe a mortgage, that's pretty healthy. I wouldn't think about this too much. It's really not a big deal because if you're good over here, then you'll be just fine over here, okay? So I don't want to spend too much time about this. The last one is also going to be 10%, and this is where the big misunderstanding is, and this is the inquiries. So I never know how to explain this in a nice way, but let me give you an example. If a client comes in and I already know they're in the 500s, and because they tell me what has happened, so you get an idea of where somebody's at, and they say, I don't want you to pull my report because it's another inquiry. So what I have to do is I have to try to tell my clients in a nice way that you have bigger issues than to worry about the inquiry. Okay, that's pretty important to know. If you're in a 500, 600s, don't worry about it. It's only 10% of the score, not a big deal. You basically have bigger problems. Okay. What's important to know is a soft inquiry versus a hard inquiry. A soft inquiry is going to be any type of report that you see, for example, online. Okay, those are soft inquiries. So those monitoring services, whether it's freecreditreport.com, there's a million of those online type of sites in which you can view your credit report. Those are okay. Those are soft inquiries. It's not going to hurt you whatsoever. A hard inquiry is going to be from any banking institution. So if you go for a auto loan and the dealership pulls your credit report, which is through the banks, of course. If you go for a mortgage, it's a bank. If you apply for credit cards, so you get the hint here, or you get the idea. It's basically the banking institutions that pull hard inquiries. Now, what I generally tell people is that as long as you are pulling an inquiry within the same industry within the 30-day period, you'll be okay. So what that means is if I'm shopping for a car and it allows for the consumer to shop for the best rate. So for instance, if I go to a Ford dealer, they pull my credit, and the next day I go to a Chevy dealer, they pull my credit. Let's say I go to a total of 4 dealerships and they all pull my credit within a 30-day window, it still counts as one inquiry because it's within the same industry. Okay, so what you don't want to do is have a whole bunch of inquiries from the auto industry and then the credit card industry and then the mortgage industry. That's where this could be a little bit more of an issue. Now, again, I only worry about this when I am speaking to somebody that has a very good score in the mid to high 700s. When you have those types of scores, then these come into play a little bit more. But if you're out there struggling with 500 range, 600 range, again, your issues are definitely more up here. So here, I just wanted to break down, again, this is what online there's a pie chart that breaks this down. it's a good rule of thumb, okay? So you just have to understand that if you're doing great with your payment history, but you're maxed out on your cards, that's not going to be a good score, and vice versa. So you just have to make sure that all these areas are really just in check. It's all about a balance. It's all about a balance. That's the main thing to know. Hope this helped. My name is Kriticos. If you have any questions, feel free to reach out.